Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, the growing instability of US trade and economic policy is really roiling markets now. China announced its retaliation to the additional August 1st American tariffs. This has infuriated the US president, who doesn't think China should respond. Why is not clear, because Beijing always said US tariffs would be responded to. Trump has announced even higher and broader tariffs since, and still doesn't expect a retaliation. And he has ordered US companies to shift operations out of China. And he is also now threatening the EU with new tariffs. It's bewildering policy made on the hoof with little thought for the implications. It's also the new normal for US policy formulation. At the first set of presidential trade volleys, Wall Street dropped 2.5% in its Friday session. Will the extended weekend announcements cause an even sharper drop when the markets open today? Well, we'll find out soon enough. US Fed boss says they have no playbook for the Trump trade war. They're struggling to figure out the right policy settings when government policy is so fickle. He stopped short of committing to more rate cuts. The Fed put is now in doubt. Then the US president reacted with more fury at the Fed chief, asking if he's a bigger threat to him than China. Is indeed now getting very silly and quite sad. One reason markets are gloomy is that no matter what happens, analysts see the negative effects of the trade war lasting much, much longer than the positive sugar hit a Fed rate cut can deliver. The Chinese currency weakened again, taking its depreciation against the US dollar since the beginning of July to 2.7%, and the Chinese authorities are struggling to keep it from sinking faster. Separately, the EU is tightening its import rules for food products related to pest control and chemical use. Canada is the first to report an impact on its cherry exports to the EU, but other products are in the gun with the EU, including apples, pears, blueberries, peppers, potatoes and tomatoes. New Zealand should feel vulnerable. In an updated review of all these vulnerabilities, Moody's has cut the growth forecast for 16 Asia-Pacific economies, including Australia and New Zealand. And the iron ore price is back down to levels we last saw in April, now down 25% since the peak in early July. Soybean and corn prices have dropped sharply too. The US Treasury yield has slumped back to be now at 1.53% and just below where it was at this time last week. Gold has leaped to $1,527 an ounce, up $27 on Saturday and up $15 for the week, or a gain of 1%. And US oil prices are suddenly weaker now at just under $54 a barrel. The Brent benchmark is unchanged for the week at $59 a barrel. And the Kiwi dollar is a little firmer on the tallest dwarf basis. Now it's 64 US cents. On the cross rates, we're up at 95.6 Australian cents. Against the euro, we're quite a bit softer at 57.1 euro cents. That puts the TWI at just on 69.2. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.